Are you trying to invest money but keep making the same mistakes? Or maybe you're feeling unsure about how to get started with investing in the first place. Well, you're not alone. A lot of people, especially when they're just starting out, tend to make some common financial mistakes that can cost them both time and money. The good news is, with the right knowledge, these mistakes are easy to avoid. In today's video, we're going to talk about the top 5 financial mistakes that many investors make, and more importantly, how you can avoid them to make smarter financial decisions. Trust me, you don't want to miss the surprising mistake we'll discuss in number 2. Let's dive in. 1. Not starting early enough. Starting early is one of the most critical factors when it comes to investing. If you delay investing for too long, you miss out on the compound growth that happens when your money earns money. The earlier you start investing, the more time your money has to grow, thanks to compounding, where your investment earnings are reinvested and they generate more earnings. It's easy to think that you'll start investing once you have more money or once you've figured it out. But the truth is, the earlier you start, the more likely you are to reach your financial goals. Even if you only invest a small amount at the beginning, starting early gives you a massive advantage. For example, if you're in your 20s and invest $100 a month into a diversified investment that averages 7% annual returns, you could end up with around $250,000 by the time you retire at 65. However, if you wait until you're 35 to start investing, you'll need to contribute much more each month, around $350 to $400 to achieve the same amount. Simply put, the longer you wait, the harder it becomes to accumulate wealth, and you could miss out on the incredible benefit of compound growth. One of the biggest advantages of starting early is that even modest monthly contributions add up over time. Many people underestimate the power of time in growing their wealth and mistakenly think they need to wait until they can invest large sums of money. But by getting started now, even if it's just a small amount, you are setting yourself up for a far more secure and prosperous future. 2. Not diversify your portfolio. Diversification is a key strategy for minimizing risk and maximizing returns. When you invest in a variety of different assets, you spread out your risk, so if one investment underperforms, your other investments can help balance it out. For example, if you put all your money in one tech stock and the stock crashes, you could lose everything. However, if you have a mix of stocks, bonds, and real estate in your portfolio, the impact of one bad investment will be lessened. By diversifying, you're also taking advantage of the fact that different assets perform well at different times. For instance, stocks might perform well during a booming economy, while bonds and precious metals may be more stable during market downturns. This diversification allows your portfolio to withstand the ups and downs of the market and ensures more steady growth over time. One way to achieve diversification is by investing in index funds or ETFs, which automatically spread your money across multiple companies or sectors, offering instant diversification. These investment vehicles allow you to access a broad range of assets without having to pick individual stocks. It's also important to remember that diversification doesn't mean simply investing in different stocks. You should also consider other asset classes like real estate, bonds, and commodities. The more diverse your portfolio is, the less likely it is that a downturn in any one sector will harm your overall returns. 3. Trying to time the market. Many new investors fall into the trap of thinking they can predict market movements, but market timing is incredibly difficult, even for most experienced professionals. Trying to time the market involves buying stocks or other assets when you believe prices are low and selling them when you believe prices are high. However, this is easier said than done, and even the most seasoned investors often fail to time the market correctly. In fact, studies have shown that trying to time the market can be one of the worst strategies for long-term growth. For example, if you miss the best 5 trading days in the stock market over a 20-year period, your returns will be significantly lower than if you stayed invested through both the good and the bad times. Instead of trying to guess when the market will rise or fall, focus on the long-term potential of your investments. Dollar cost averaging, DCA, is a great strategy to avoid the pitfalls of market timing. By consistently investing a set amount of money at regular intervals, no matter what the market is doing, you avoid the emotional roller coaster of trying to buy at the perfect moment. One of the best things you can do is develop a long-term investment strategy and stick to it. Over time, The market has historically risen despite short-term fluctuations. By staying invested through all types of market conditions, you're likely to see more growth than if you keep trying to time the market. Stay focused on your long-term goals and avoid the temptation to react to short-term market movements. 4. Ignoring fees and expenses. Investment fees might seem insignificant when you first look at them, but over time, they can add up and eat into your profits. Whether it's mutual fund management fees, trading commissions, or advisor fees, all of these costs reduce the amount of money you make from your investments. For example, a mutual fund with a 1.5% annual fee might not seem like much, but over the course of 30 years, that can cost you thousands of dollars in lost potential returns. The problem with high fees is that they reduce your overall return on investment. Even if your investment earns an average return of 7%, the fees can eat away at your profits, making it harder to build wealth. For instance, if you invest $10,000 with a 1.5% fee, your annual returns will be lower than if you invested the same amount in a low-fee index fund. While a 1.5% fee might seem small, it can compound over time and take a significant chunk of your returns. That's why it's important to research and choose low-cost options, such as index funds or ETFs, that have much lower fees compared to actively managed funds. It's also important to understand the fee structure of any investment account you use. Some brokers charge flat fees, while others charge fees based on percentage of your account balance. These fees can quickly add up, especially if you're making frequent trades or investing a large amount of money. By minimizing fees, you can maximize your returns and ensure that more of your money is working for you. 5. Failing to rebalance your portfolio. As time passes, some of your investments will perform better than others, causing your asset allocation to become unbalanced. Rebalancing your portfolio is the process of adjusting your investments to maintain your target allocation. For example, if you initially set your portfolio to be 60% stocks and 40% bonds, but your stocks have grown to make up 80% of your portfolio, you need to sell some of your stocks and buy more bonds to restore the original balance. Failing to rebalance your portfolio can lead to higher levels of risk than you're comfortable with. For instance, if you have too much exposure to one asset class, like stocks, your portfolio may become too volatile, especially if the stock market experiences a downturn. On the other hand, if your bonds have grown too much, you might be missing out on higher returns from stocks. Rebalancing ensures that your portfolio remains aligned with your risk tolerance and investment goals, helping you maintain a steady growth trajectory. Rebalancing doesn't have to be complicated, and many brokers offer automatic rebalancing services. For example, if you invest in an index fund or a target date fund, the fund automatically rebalances itself over time to ensure that your asset allocation remains in line with your goals. If you manage your own investments, it's a good idea to review your portfolio once or twice a year and make any necessary adjustments. Rebalancing ensures that your investments are working as efficiently as possible and that your portfolio stays aligned with your long-term financial goals. Investing is a powerful way to build wealth, but it's easy to make costly mistakes along the way. By avoiding these 5 common mistakes, waiting too long to start, failing to diversify, try to time the market, ignoring fees, and neglecting to rebalance your portfolio, you can increase your chances of financial success and grow your wealth over time. Remember, investing is a journey, and the key to success is staying focused on your long-term goals, being patient, and making smart, informed decisions. If you enjoyed this video, like, share, and subscribe for more investing tips and advice. Drop a comment below and let us know what financial mistakes you've learned from or want to avoid. Thanks for watching, and I'll see you in the next video.